day, everyone. Thank you for joining us once again here at Seafried and Brew for our economic briefing. I am Jamie Sumner, Chief Analyst, and for this week's briefing, we want to review over that second quarter GDP number that came out last week, and also look at some of the inflation numbers that came out just this morning. And then we'll wrap it up looking at that Fed funds future probability rates going out into next year. So when you look at the overall level of growth for the second quarter, fairly strong here, 4.1%. In fact, we'd have to go all the way back to 2014 to get a number that is higher, and that was in the third quarter. But notice as we move forward, what tends to happen in the next couple of quarters is we start to see this downward momentum. We had that really high quarter back here in the third quarter 2014, and then we came down in the final quarter, two stronger quarters in the first two quarters of 2015, and then ending the year on a low point. 2016 picked up for the second quarter and then kind of trended down, and that similar occurrence in 2017. So will 2018 take the same path in here with a high second quarter number and then kind of trailing off throughout the rest of the year? Most likely that is what will happen. The question is how much of a pull-off will we see? When we look at that overall 4.1% growth rate and we look at that compared to the GDPNow, the GDPNow did a really good job this quarter in projecting out that growth rate. The last estimate on July 26 came in at 3.8%, so very close to that 4.1. And overall, the average of all the estimates throughout the quarter was 4.2%. So the GDPNow, again, as we said before, is a pretty good estimate of where we see where that GDP growth tends to come in. In fact, if you look all the way back to that first release that they had, it was 4.1% right on the dot. So that's a pretty impressive for the Atlanta Fed, and that's why we continue to look at this throughout the quarter. When we look at the individual contribution efforts of each one, of each of different segments, consumer, the biggest portion of GDP, representing about 70% of our economy, contributed 269 basis points to the overall GDP growth. That's very strong, especially when you take that in consideration and compare that to the first quarter growth, which was only 36 basis points. So we had a huge increase, and a lot of that was due to the durable goods, which increased an overall 9.3% for the quarter. So very strong in the durable goods orders. And then we look at the non-durable goods, also up 4.2%. So both durable and non-durable goods strong, and we had an increase in the overall services area, pushing that number up to contributing 269 basis points. Very strong. The disappointing number here was this private investments actually detracting or taking away from that GDP growth rate by 6 basis points. A lot of this, if you look at the numbers, inventories actually went down, and that took away a whole 100 basis points from GDP. So we stripped that out, but also the overall growth rate in the structures and the growth rate in equipment also came down, but they were still fairly strong. In fact, structures were up 13.3%, down from where it was in the first quarter at 13.9%. And then we also had residential fixed investments come down, which contributed to this negative number here. But when you look at the change from the first quarter to the second quarter, you can see that big drop from adding 161 basis points to taking away 6 basis points. So hopefully what we'll see in the third quarter would be a ramp up of those inventories and then contributing positively to the overall investment number, and a continuation of the growth in structures and the growth in the equipment spending on these businesses. That's what we're hoping to see as we move forward. Government, similar to last quarter, added 37 basis points compared to 27 basis points. And then we had that exports imports number adding 106 basis points, really pushing forward compared to last quarter when we saw it detracting by that 2 basis points. So that 106 basis points, a lot of that was a strong growth in exports. And we saw exports goods go up by 9.3%. That's a very strong number in exports. In fact, you'd have to look back all the way back to the fourth quarter of 2013 to get a number that's higher than that growth rate on a quarterly basis. So that's very strong, and hopefully we can continue to see that. Kind of questioning that with the tariffs being implemented or potentially being implemented in here, and then the pull off, maybe the big push in that growth rate was the soybeans really ramped up in that second quarter. But we'll see if we can continue to have this number be positive as the trade gap narrows. But overall, very strong GDP number this quarter, up to 4.1%. We will have the second release or a second estimate coming out at the end, in the end of August. So we look forward to see how this number changes at that time. But overall, when we look at the inflation, we still see inflation getting up close to that 2% mark. We had that core PCE at 1.9%, just below the consensus of 2%. So we saw inflation not come in as strong as anticipated, both on the core and the straight inflation number. But we are getting close to that 2%, giving credence to the Fed strategy of gradually increasing that Fed funds rate over the course of the next couple of years. But when we look at it, this is suggesting not a runaway inflation, just steadily increasing in here. Also, when we look at the employee cost index, we can see overall up 2.8% year over year for the employee cost index. So we're up over that average of 2.66% throughout this time period. However, when we look prior to 2008, we can see that average was 3.5%, so much higher than where we are today. So we got to think about that. We still haven't seen that big ramp up in employment or wage inflation that we would expect with this low level of unemployment. So we can look forward as the year progresses to see if we start to see a pickup in that wage inflation. We've seen it steadily increase, but no spikes in here, and that's kind of what we want to have. When we're thinking about the Fed funds and the probabilities of increases, the Fed is meeting this week, today and tomorrow, and then they'll come out not expected to do anything. The rate stays the same. We look out into September, and there is a 76% probability of an increase in rates going up to that 2 to 2.25 range. And then we look at it staying the same for the November, and then in December, they're anticipating another increase in that rate, and at a 56% probability. And then after that, we look out into March in here in 2019, and we have a 38%, so we're kind of on the line here, almost equal with where we are in that December number, in that 2.25 to 2.5. So we're kind of teetering here, maybe not changing rates. The next two kind of locked in. After that, wondering if they're going to settle down and maybe pull off a little bit as far as what the market is telling us with these implied probabilities. So it will be interesting when you think about this, apply this to your overall ALM strategies and into your models to determine how this is going to impact your overall deposit rates and we'll continue to report on those deposit rates once a month to show where the top rates are and how they've been moving throughout this time period. So we look forward to talking to you again in the near future. Have a great day, everyone.